Hello, I want to talk briefly about prepayment penalties. Most loans have prepayment penalties, and the rationale is the lender wants to make a loan, they work hard to make the loan, and they want to keep the loan out there for a period of time. And they also can calculate how many loans they think are going to get paid off and what the returns are going to be over any given time frame. Also, the prepayment penalty captures the client and allows the bank to obviously have that client on their books for the duration. So in commercial real estate, there are two or three types of prepayment penalties. One is called a declining or step down prepay. Another is called yield maintenance. Another is called, and this is mostly in the CMBS world, defeasance. And there's also a concept known as lockout, which in some cases allows a prepay, but you can still allows a prepay only after a lockout period, meaning that you cannot prepay it for a certain period of time. A step down prepay or declining prepay is generally tied to the term of the fixed duration of a loan. So if you have, for instance, a 5-year loan term, the fixed term is 5 years, you would have what they refer to as a 5-4-3-2-1 at some lenders. Some lenders might have 5% for the first 3 years and then 1-1-1% for the last few years. So it just really depends on what the lender publishes and what you can negotiate. So 5-4-3-2-1 on a 5-year term would mean that you would take the amount of the loan, multiply it by 5%, and if you were to prepay that loan in the first 12 months, in the first year of the life of that loan, you would owe the bank 5% prepay, and it declines from there, whereby in the last year of the loan, you would have 0 prepay. In some loans, and it's discussed in another section, some loans would then revert to an ARM or an adjustable at that point, but there'd be no prepay, so you'd be able to then pay off that loan and go get another loan if interest rates were to come down, for instance, and you wanted to refinance it, or you just didn't want to be subject to the vagaries of the market having an adjustable rate loan. So that's declining prepay. Yield maintenance or interest guarantee is the idea that an institution is making a loan or buying a loan, and that institution doesn't want to be in the business of churning loans. They just want to purchase a loan or make a loan as an investment vehicle. They have it on their books. They know what the return is going to be, and that's the yield, for example, in a portfolio of loans that they're expected to make. So if you go and prepay, well, they want to maintain that yield, and there's a calculation. It's essentially a present value calculation, and then some yield maintenance prepays and get a little bit more complicated because it begins to include the value of other alternative investments that institution can make at that point in time. So yield maintenance calculations are not as simple as they may seem, but the basic idea is that you have to provide to the maker of the loan or the buyer of the loan the yield that they essentially bought. They bought a certain yield and they want it. And if you were to prepay, they wouldn't get it. So you have to make up the difference, make them whole. So that is what a yield maintenance prepay is. Most CMBS loans or institutional size loans have a yield maintenance prepay. Most banks have what's called a declining prepay. You also will have on a CMBS loan defeasance. If you look up defeasance, basically what it is in the bond world, it's a word that comes out of the bond world. So keep in mind that commercial mortgage-backed securities are essentially bonds, And if you wanted to pay off the loan, what you'd be doing is defeasing the bonds, which means that you're replacing the bonds that you're paying off with another set of bonds that the institutional investor can then draw yield from. And the cost of doing that in the first few years of a CMBS loan is generally very, very prohibitive as a percentage. And this is just a generality, but as a percentage, that prepay, if you will, or the defeasance ends up being greater than 10% in the first several years of the loan. So it's very rarely used unless there's an extremely good reason for it. So there's a mechanism by which you can purchase bonds, and then essentially those bonds will swap out for your bond, i.e. your loan, to make the holder of the notes whole. It's very expensive to do. There's a lot of legal fees. There's transaction costs. So it can be quite costly to accomplish. Just as an aside, I don't want to get off on a tangent, but if you're dealing with investors who are looking to harvest equity out of appreciating assets, obviously something with defeasance or yield maintenance probably not the best execution for them. So it's something that needs to be thought of up front. The prepay issue generally always comes up. Most folks, if they think they're going to keep a property long term, it's nothing for them. They'll pretty much accept the language as it is. Again, if somebody is looking to harvest money from their real estate portfolios over time, the prepay can become a deal killer. So it's worth it to understand how to negotiate that. So thank you very much. That is our brief explanation of prepays.